Mickey Dickey here, and I'm going to give you my 2 cents worth on what I think is going on with Powell and interest rates and so forth. And as I've said before, what I'm really trying to do is make sure that the information that's out there is accurate. So this is the actual video. This is not edited. This isn't for glamour purposes or all the other kind of stuff on the news. And I want you to listen to what Powell is actually saying rather than what people are insinuating that he says. So I'll make some comments as we go along.
You paused, but you're not calling it a pause, and you're not calling it a skip. So what are we calling it?
First of all, Sarah, thank you, and Christine, thanks for hosting us here in Sintra. What we're calling it is maintaining the level of the federal funds rate at its current level for this meeting. Thank you.
Like everything else in the world, we just can't use real words and use the actual language that's out there. We've got to make stuff up. It's a pause. And again, I don't care what you want to call it. It's a lot like other things out there. It doesn't really matter what you want to call it, what the name of it is, if they paused. Now, what I want you to, and I'll call it maintaining now. I guess that'll be the new word. But listen to what else he says here, because what the news is making out of this is not reality.
Thank you. And we did that, if you think about it, we've raised the federal funds rate by 500 basis points since a little more than a year ago.
And I love it when he comes back and just tells us the obvious. We all know this isn't new. This has been going on every freaking day for almost 2 years now. We've been talking about this baloney.
We think, so we've come a long way. We also think that there's more tightening power coming through. Really, policy hasn't been restrictive for very long. We started at
Okay, and again, I know I'm stopping this and starting this a lot, but I want you to listen to what he actually said there. And what he's saying is that there's a lot of tightening coming through. Not because he's doing more tightening, but because of what he's already done. Okay? And again, whether you believe what he's done is doing the tightening or not is not really relevant in my book, because again, I don't know that he needed to do anything, but that's just my opinion. What I can tell you is that what he has done has not shown up yet. The stuff that he did back in November has not shown up yet. The stuff we did in December has not shown up yet. So there is more tightening. Now, does that mean he needs to do more interest rate tightening? Absolutely not. And I'm here to tell you, the next thing that's going to happen here in the marketplace at some point, they're all going to start talking about the fact he's gone too far. It's going to happen. Now, whether you believe it or not, trust me, there will come a point, we will walk in the door one day, and all of a sudden, the rhetoric will change, and it's going to be, he's gone too far. Trust me, it's going to happen.
Negative real interest rates, and we've now moved up to where we actually are in restrictive territory, but we haven't been there very long. So we believe there's more restriction coming. And what's really driving it, to Andrew's point and Christine's as well, is very strong labor market. We've got a labor market where jobs are being created, there's strong wage gains, and that's driving spending, driving real incomes and driving spending, which is driving more demand and continuing to drive labor market. So the labor market is really pulling the economy. And
oh, horror of horrors. The labor market is strong. Again, this is the one part of this that it's the disconnect I don't understand, and I can't understand why we continue to work on this and beat it to death. Having a strong labor market is a good thing. You will never convince me otherwise. There's not a darn thing you can do to convince me, because statistics will not back you up. When you have a strong labor force, you can go through darn near anything, which is what's happening here. We're working through all the baloney that we did during COVID and all the garbage that we've done since then. So yes, we have a strong labor force, and that's fantastic. The interest rates are not doing, again, I don't think it's affected anything, but the inflation's at 4%. They're projecting 3.1 for the month of June to come out in a couple of weeks, which means most probably in August, when we get the July numbers, we're going to be in the 2% range. Might be 2.7, might be 2.8, whatever, but it's going to be in the 2s. I'm telling you, if you keep going down this path, the old credibility issue is going to go away, which is why I really think they're going to come back and go, they're going to erase the credibility part of the Fed and say that he's gone too far. Again, my opinion.
My colleagues and I, as you will know, wrote down in our SEP 2 more additional rate hikes. The median was quite a strong majority, actually wanted 2 or more rate hikes. And the reason for that was, if you look at the data over the last quarter, which is stronger than expected growth, a tighter than expected labor market, and higher than expected inflation.
Okay. I have to take question with this. He says, again, it is a stronger labor force, it is a stronger economy. Yes, he's right. But inflation is not higher than projected. That is not true at all. You have not told us that you have projected inflation to be under where it's at yet. In fact, you're not talking about getting it down to your 2% that you're looking for months. It's at 4. It's come down from 9. And again, I don't like any of it, don't get me wrong, but that statement is incorrect. It is not higher than expected. It's exactly where expected. In fact, it's probably a little bit lower than expected.
So that tells us that although policy is restrictive, it may not be restrictive enough, and it has not been restrictive for long enough.
So I don't get why you didn't raise rates at the last meeting, especially I think it was a surprise that it was a unanimous decision to hold.
And see, this is where the credibility starts to fall apart and why I think the market is doing what it's doing at the moment. If you truly thought that you needed more restriction, and I don't mean restriction in the fact that you're not doing anything more. If you truly think that you need to have 1 or 2 or more interest rate hikes, you wouldn't have stopped, which means to me you didn't think that. And again, you can say whatever you want, but this is where this contradiction is coming in. And I do think that Powell and the Fed is losing some credibility here because they're just not speaking it true. They're trying to be hard, I get it, but when you speak untruths, again, people are not stupid. They're going to figure this out.
Hold rates steady when you said a majority think that they still need to go farther on raising rates.
It's really just as you get closer and closer to the goal. What we're aiming for is a stance of policy that's sufficiently restrictive to bring inflation down to 2% over time. As you get closer to that, you get closer to the place where the risks become more in balance. We did 4 75 basis point hikes in a row starting in June of last year. In December, we moved down to 50. Then we did 3 consecutive 25 basis points.
Okay, we're regurgitating the same thing over and over again. And for those of you who haven't seen all my other videos, one of the things I'm going to suggest here now is I'm a private pilot. Don't fly a ton, but I am a pilot. And one of the things I was taught years and years ago is that when you're flying to an airport, basically runways are set up on radials, which is just a part of you have 360 degrees, okay? You come in on them. And if you're trying to land on a runway and you're flying your plane, and I'm going to use this as an example if I can get this to work right, but as you're coming through, if you don't turn at some point, same thing with on a road. If you're on a crossroad and you're coming to try to meet it, unless you start slowing down and curve at some point, you're going to blow right through the road. So you have to turn and curve onto the road you want to be on. And that's what he's talking about here. And I get the point that in order to get onto the path that you want to go without going past it, you got to start curving. So you got to slow down, which is why everyone knows what he's saying here. And what he's saying is not what in reality is going on. He's not planning on raising 2 more times unless something out there isn't what we see. Because again, if we're truly going to be at 3.1 in June and in the 2s in July, and more importantly, real estate hasn't rolled over yet, and I'll talk more about this in other videos, but real estate, or shelter as it's called in CPI, is 39%, and it's still at 8% year over year, and it will roll over. And when it does roll over, it's not going to make inflation as sticky as they're talking about. So yes, the core is sticky, and I'm not disagreeing with him there. It probably is going to be. We had General Mills come out today and say that they're going to have some difficulty raising prices, and their margins are going to get squeezed, and there's some problems. I get it, but it's not going to be as big of an issue on inflation as he's been talking about.
Point hikes. So this is really just a continuation. We're going to move the decisions a little bit, make them a little bit more time in between them, in an effort to get more information from the data to see how much restraint is really coming from these through the pipeline from rate hikes that we only made now in many cases 6, 8, 9 months ago. So that's why we did it.
So maybe in every other meeting hike.
We've not decided that. So no, the only thing we decided was not to raise rates at the June meeting. We have not made a decision to go to that. It may work out that way. It may not work out that way, but I wouldn't take moving at consecutive meetings off the table at all.
So again, what he's saying here, and this is really what this all boils down to in the scheme of things, they haven't decided to do anything yet, and they won't decide to do anything yet. They're going to go off of data, and if the data is saying we don't need to do anymore, they're not doing anymore, because he's exactly right. What they've already done is not in the market. And if we're truly at say 2.7 in August. Real estate still hasn't rolled over yet, and it's going to on the CPI, shelter again. There's really not going to be any need to raise more. Yes, he's going to have to keep it up there for a long period of time. And again, what's long? Is it 6 months, 3 months, 1 month, a year? We don't know. And you don't know because, again, you're trying to converge onto that road. And how do you curve onto it? It just depends on how inflation's coming down. But I'm telling you, at some point here, because of this restriction or the verbiage that he's got on this restriction part, they're going to turn it the other direction because that's what's going to happen. They're just not going to go up. He's not going to say he's not going to go up. They're just going to say, well, we're not going to go up this period. We're not going to go up this period. Again, we can just walk through this for months and years on a time. That's just the way it's going to be. So that's my 2 cents worth. Again, listen to what he actually says. Don't listen to the news because they're not going to tell it to you. They're going to have some stupid spin on it. He's not saying there's more restriction coming from him necessarily. There's more restriction coming from what he's already done. And that's absolutely true. And it is more restrictive coming down the road. And what he's also saying by saying that they haven't decided anything yet is he's going to be data dependent. And that's all we really need from him at this point. He's going to be data dependent for as long as he's in office, and the next Fed chair is going to be the same.